So, hello and good afternoon. I welcome you to today's weekly market outlook for Admiral Markets on the 15th of March 2019. My name is Jens Klatt, and I'm the moderator of the upcoming 45, 50 minutes around to give you an idea of my view on the markets for the upcoming week of trading. And thank you very much for the feedback. Vincenzo just wrote audio and video links work 100%. That's perfect. Thank you very much. I think we have plenty of topics to cover, so we don't want to waste too much time. There has been plenty of news over the last days around the Brexit. The DAX is about to see the so-called in Germany we call it Hexensabbat, so it's triple witching today, with some squeeze movements before right 1 p.m. German time now. So right now, there's the expiration of the FDAX, respectively, several options, and there has been a quite elevated open interest of short calls here at 11,700 points. I think we just closed slightly below that level, so those options expired now, worthless for those who were long those calls. But nevertheless, the question is now, after the squeeze higher, will there be will market participant defend that level still now after the expiration is through or not? So in my opinion, I think we have a good chance to see a bullish weekly close. This is especially true if US equity markets break higher. So this is the first topic we want to cover. Then beside the Brexit, we also do not only have the DAX here, but also a seasonal pattern for Euro Australian dollar, for example, a very, very favorable pattern over, or a profitable pattern over the last 24 years I'd like to present, especially based on the fact that also the ECB has been quite dovish already last week. And so all these topics which will be covered here will take some time. So let's just start right into the action. Before, sure, we have to click through the risk disclaimer here. And be sure that you understand that the financial instruments offered by Admiral Markets carry a high level of risk, which may not be suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral. For further info here, please feel free to go over to the website, the web presence from Admiral Markets, admiralmarkets.com, where you'll also find the risk disclaimer and the contact details, which nevertheless will be presented here in a slide in a few minutes. One thing we want to dig a little deeper into here around the risks is the differentiation now between retail clients and professional clients, in effect since August 2018, the so-called ESMA decision. The ESMA decision means that retail clients now only can use a maximum of 1 to 30, a max leverage of 1 to 30 in Forex majors like Euro USD, but and also 1 to 20 in other currency pairs like for example Euro Australian dollar, so-called minor currency pair, but also CFDs like the DAX 30 or also gold. The main differentiation here between retail and professional clients is not only the leverage, but also the fact that retail clients have a negative balance protection, so an unlimited protection against negative balances, while professional clients, and this is special about Admiral Markets, professional clients also have a negative balance protection up to £50,000 sterling according to their policy. So for further information, please feel free to contact Admiral on this topic also directly. Also regarding the question, if you qualify to become a professional client, so there's certain criteria which has to be met, and just feel free to reach out to Admiral directly to get further information on this topic. So this is me, the face to the voice you're currently listening to. And the question here is also, sure, why Admiral Markets? I'm located in Berlin, Germany. Admiral Markets is not only a global player right now with several offices around the globe, and also one, by the way, in Berlin, Germany here. But also in Germany, we usually refer for several years now to Admiral Markets as the so-called DAX expert with a typical spread of 0.8 points during the main trading hours. They also have a new offering right now, if I'm not mistaken, which is a typical spread of 0.2, and on top of that, you can pay a commission. This may be of high interest, especially for short-term slash scalpers, short-term traders slash scalpers, because the smaller spread here could mean a step towards profitability or higher profitability in your trading when scalping the DAX. So also feel free for further informations to reach out to Admiral directly on this topic. Global player, so one world, global offers. It's not only that Admiral is located in several countries around the globe, but also registered and regulated, authorized by different regulatory bodies like the FCA in Great Britain, but also, for example, the Australian Financial Service has an Australian Financial Service license and is allowed to do business in Australia. What this could mean for your trading, also feel free to reach out to Admiral directly and contact their support. Here is the contact details where you can get further informations. And now we want to here have a look at our agenda for today. The following questions we want to answer, I will try to answer, are what, first of all, are the key economic events in the coming trading week. In this regards, I can already say what I definitely will look at is the rate decision of the Bank of England next week on Thursday. But not only that, but also the employment situation, which will be published on Tuesday, and then the inflation rate, which will be published on Wednesday. To make long things short, I'm currently, after all the developments around the Brexit, positive for pound sterling. I could really imagine that, especially if the data sets come in as expected, probably or also coming in better than expected, that this could result in combination with the now to be expected extension of the Brexit deadline, that here this could lead to some optimism in pound sterling, which could drive pound sterling, for example, against the US dollar higher, but also against, for example, a more, let's call it exotic currency pair, like pound sterling against Swiss franc. There's also a seasonal pattern, which we could make a topic, by the way. But before the second question, what's the current bias in the FX equity and commodity markets? Sure, a question which is important to answer right now, and which trading opportunities may arise from all of this. And so from here, let's move over to the chart. And there we have it. So it's 1 p.m. German time. This is 1 p.m. It's 1:08 right now, p.m. German time. That means the so-called Hexensabbat triple witching is through, expiration is through. So, and now the question surely comes to our mind, what could this mean for the DAX here? And first of all, we want to start here with the daily chart, have a look here, and point out that the current region we are trading against, 11,700 points, is of high interest because of several reasons. So it has been a significant zone of resistance from November, December onwards, but has been a strong support too here. It is now acting most likely, therefore, as a resistance zone, because usually if you break below a certain and strong support, it usually becomes a resistance zone afterwards. And that's one of the reasons why this region is of high interest right now. And what you can also see is that we are coming closer towards the so-called 200 simple moving average. This is this purple line. So usually, even though it's a rough indicator, it's an indicator known to be used by many bigger players in the market, institutional clients, for example, to get an idea where's the overall advantage. And especially if you're currently trading not far away from it, it's not uncommon, in my opinion, respectively based on my experience, that this line acts as a kind of magnet on the upside. So it wouldn't come as a surprise if we make no new daily highs right now, that the market then continues to perform on the upside, and the DAX will move as high as 11,800, 830 points or something, and retest this 200 simple moving average into the weekly close. So that's it around the technical perspective, or from a technical side. So what we've seen now is, and this is definitely very interesting, especially here, we've found resistance against this region several times over the last days, and then over the last 2 hours, there was a very interesting price action taking place here, especially with this squeeze higher that was around 1 hour before this big expiration took place. And we've seen that there was a serious attack at this level at 11,700 points. And I have to say, I think it was really close. What we got to see here, I think we had a very good chance to squeeze significantly higher over the last hour or so, and it was really, really close for those options here, or those market participants who were short calls against 11,700 points. Why do I say that? I've prepared now a website. It's a German website, and unfortunately, we do not have access, or at least not the old way anymore, access to the open interest at the Eurex. You probably recall that over several last webinars we did here, from time to time, I had a look here at those levels at the Eurex and the higher or the open interest in general, short calls, respectively short puts. Unfortunately, the link doesn't work anymore, and it's very difficult to find. I'm not even sure whether it's still possible to find those data anymore and to draw conclusions out of that. But in Germany, there's a website who takes care of that, and they are preparing such a chart here, which is at first glance difficult to read, but at second you will see that it's not difficult at all anymore. And this is something where you can now snapshot this, and then we go through it. So what you can see here, unfortunately, it's a little small, but here you can see the open interest. So this is the level of written calls in this case on the upside, while we have here the strike on the left. So the blue lines are the calls, while the red ones are the puts. We are focusing here on the blue one, and you can clearly spot that this line is by far the largest. And this is the open interest at 11,700 points. So to make long things short, that means nothing more than the market participants were really looking for this level, and it's nothing more than a bet that the market will trade below 11,700 points at 1 p.m. today, at the big expiration. So now the thing is, you probably wonder what could have happened if the market pushed above that level, and therefore we probably should have a look here at a picture I will draw now. So what you probably know is here is the following. What you see here, this is what we call a long put. Okay, and so long puts, they make money once they trade above a certain threshold, 11,700 points in this case. So this is our so-called strike price. So, and then what you can see here is you pay this price. So this is the premium you have to pay, while you make money the moment the market trades above 11,700 points. Why do you make money? Well, let's say the market trades at 12,000 points at 1 p.m. today. Okay, when the expiration takes place, then you're allowed here, you have the right to buy the DAX in this case, so the underlying, to 11,700 points. So the difference is 300 points. You're buying 300 points below the current market price, and the difference is your profit in this case. So now the thing is, this is a long call in this case. Okay, so what does a short call look like? Well, it's the complete opposite. So the short call, the one who's selling you this option, he makes money as long as the market trades below, in this case, 11,700 points. So he's gaining the premium, 11,700. oh, sorry, let me put it that way. So he's making money as long as we trade below the level. And once we break above that, he's obviously losing money. And what he has to do is he has to hedge here his, in this case, short exposure he holds, which means he has to buy a product which has a payout which is similar to this one here, which means you get this payout, the red line in this case, if you're buying the DAX in this case, the FDAX. So that said, it means nothing more than, now let's come back here to this chart. It means nothing more than the blue line. It shows that market participants are obviously betting that the market will trade below 11,700 points. And if this bet is not playing out, well, they have to buy the DAX. Or in the moment the DAX pushes above 11,700, they obviously have to aggressively buy the DAX. They're certainly not doing that right at the time when the market starts to tick slightly above 11,700 points. But I think the threshold here will be somewhere around 11,730 to 11,750. And now have a look here, and then usually automats are or algorithms are stepping into the market and start to aggressively hedge this exposure for those market participants. So what you can see here in this moment is that the market traded to 11,700 points, slightly below that threshold, my personal threshold. But if you look at it for several times, you will see that usually from 730 onwards, then or 30 points above this level, usually then hedging kicks in. And so we stopped slightly below that level, which is probably also because those market participants stepped in and said, okay, we defend this level now. We try to push the market below 11,700 points. By the way, you can see it here. They most likely succeeded. Depending on where the expiration really took place. That's something I don't know yet. I haven't double checked it, but that means nothing more than those market participants can't take a profitable bet then, because the market expired below 11,700, which means nothing more. Those market participants are here making money, obviously. So now, and this is what the real question is. This is past, so it's nothing which is of interest for us anymore. But what's of interest now is surely, well, if those defendants here are now stepping out of the way because they say, hey, we made our money for today, the options expired worthless, we have the premium and that's it, and now we don't need to sell the DAX against 11,700 anymore. Well, if these defendants now step back, this means nothing more that the DAX has some more potential on the upside and is probably to be treated or to be traded from the long side for the days or hours to come, which is probably especially true when looking at the S&P in this case. Oh, by the way, I'm sorry. So what I did do here is the following. I've prepared already a chart for next week. It's a window which is of interest for short-term traders when it comes to Fed decisions. So something we will mention in a few seconds here for the outlook for upcoming week, and then you can paint a very interesting behavior, or we have seen a very, very interesting behavior here in the S&P during over, I think, something like 40 years or so. So with a tendency in the S&P to trade higher the day before the Fed rate decision here. But this is not what's of interest right now, but what's of more or higher interest is the short-term relevance of this level. So have a look at this level here in the S&P, and what you can clearly see is that 2,815 to 2,820 points is a very strong line of resistance here in the S&P too. And if we are breaking above this red line, I think it's not only the case that this can be considered a bullish breakout, at least a short-term bullish breakout, but usually based on the positive divergence, positive correlation you have between U.S. equities and in this case our German DAX. The thing is that such a break higher could act as a further driver higher for the DAX then, and push the DAX up to minimum 11,800 to 830 points. So to put it differently, if I had to take a position right now, I definitely favor long engagements. Probably go for a short squeeze with something like I trade a break above 11,720 points higher. That would be my buy stop, with a stop placed here somewhere around this low 11,675 to 11,680, and then go for a push up to 11,800 points, resulting in a risk reward of 1 to 2. Yeah, and this is my short-term outlook for the DAX here. Even though I have to say, the nearer we come to the opening of the U.S. equity markets, the more my focus switches over to U.S. equity. So probably it's of higher interest to go for a classic open range setup or something in the S&P, trying to anticipate such a break higher. I could imagine that here then, also based on the current momentum and the outlook for a very equity-friendly Fed, for example, and the Trump administration obviously doing everything they can to support equity markets. So if we look at it from this perspective, then a break higher here could result in a quite aggressive squeeze higher, which is of interest for those looking for long engagements, probably based on the open range setup. So yeah, it's your choice at the end. If you take the S&P or if you take the DAX, I favor, to be honest, the S&P somehow a little. The trading window for the DAX is it's difficult to say, but somehow it seems to be over. So I know that the main action in the DAX, based on my experience for nearly 10 years now, trading the DAX actively, I know that the main trading window is between 9 to 11 German time, so which means 8 to 10 AM GMT. And after that, it's mainly driven by, especially in the afternoon, action in the US equity markets. Yeah, so that's it on the DAX. Let's just see how it plays out. Probably I'm completely mistaken. It's a fake out on the upside in the DAX, and then we just see not only the DAX giving back all these gains, but also the S&P here not breaking higher, but instead see a sharp bounce back. Let's just see what happens. So in around 2 hours from now, we definitely know more, probably 3 hours from now, depending on how the US equity markets start into the day. This is also something which is of interest then for the next week. So let's give an outlook here. I'm somehow still a little doubtful. So even though I've now drawn a quite bullish picture for equity markets, especially after yesterday, and especially after yesterday's sharper drop lower in the DAX. Here, let me just show you what I'm talking about. So yesterday there was this here, this candle. I'm talking about this candle. You can see it in all, if you look at the overall picture, it's no big deal. But nevertheless, the question is, what happened here? Why was this sharp bounce lower? What was the reason for that? And it was that there was the news that Donald Trump and Xi Jinping, the Prime Minister of China, will meet somewhere in April. And this is especially interesting because the meeting between those two is mainly attached to the trade negotiations going on between the US and China right now. So there have been several mentionings of the negotiations going well, not only by Trump himself via Twitter, but also by, for example, the Wall Street Journal. And this is going on for months right now. And the thing is that the longer these negotiations take and the more often we get to hear something like the negotiations going well, the more likely it somehow becomes that no deal will be found at all. So, and after yesterday, the news hit the wire that those two will meet in April. It's becoming obvious that obviously there's some tensions, at least let's call it some tensions, and especially after Donald Trump attached his performance as U.S. president to the performance of the equity markets, especially in the U.S. The thing is that it seems more and more as if we are probably about to see a big disappointment here. And based on that, especially if those negotiations fall apart and no deal is presented, this could result in a sharper drop in not only U.S. equities, but this could surely also and quickly spill over to European equity markets and especially the DAX in this case. And so with this in mind, even though there's a short-term squeeze potential on the upside, I don't see the DAX trading back significantly above the 200 simple moving average, but instead probably finding some kind of resistance here, and probably this will act then as kind of preparation for a move lower against this level, which is especially dangerous, let's say, for the bulls once we push below 11,400 points, because such a push lower would make it likely that we go as low as 11,000 points. Nevertheless, I've already said it. It depends somehow a little on the Fed next week. I don't think that the Fed can really, after the first quarter now, deliver anything which will result in sharper gains then in equity markets in general on the upside. But the tendency, the seasonality is usually that you say before the Fed, you have a tendency of a drift higher in equities, especially in US equities, but this is also true for the DAX. So with this in mind, if I had to give a time span from which a drop lower is more likely, I definitely go for the second half of next week. Do not see this drop lower, given the current facts. Do not see this drop lower in the range between Monday to Wednesday. Just let's see. But all in all, don't be too aggressive with short engagements right now, especially not today, given the technical picture I've drawn several minutes ago. Yeah, so that's it on the DAX. Let's have a look now at the Euro USD here. And afterwards, we'll have a look at pound sterling. So Euro USD respectively, especially Euro Australian dollar, and the seasonal pattern, which we are having then from next week onwards, from the 18th of March. First of all, a short overlook here of what happened in Euro USD. So what we can definitely see and spot here is that the attack and the push below 112 after the ECB took place last week on Thursday, that this obviously was only a fake out on the downside. And now we see a bounce back into the range and into the overall neutral mode. And I have to say, I don't really see Euro trading significantly lower over the next days here against the US dollar, based on the current weakness in the US dollar in general. And this is especially true if the Fed then next Wednesday comes out more dovish than expected. Therefore, let's just probably have a look here at another interesting chart. This is the 10-year US yield on Treasury notes, and what you can see is that we are currently trading at 2.6%. If we look at it from a 3-month perspective, or probably 6 months, that's probably a little better. We have the last quarter and then the current quarter. What you can see is the highs here of 2019 were marked around 2.78%. And from there, that was on the 18th of January. From there, we traded lower and currently drifting towards the yearly lows, which can be found at 2.56, 2.55% here. Why do I say that? Well, as long as U.S. yields keep on being under pressure, we shouldn't expect the euro gaining an advantage. The U.S. dollar. I'm sorry, the other way around. We shouldn't expect the U.S. dollar gaining against the euro because the advantage the U.S. dollar has in terms of yields against the euro is obviously diminishing. This is still very interesting, especially when looking then at gold here in this perspective, because gold yesterday had a very weak day, giving back nearly all those weekly gains. And the question quickly comes to your mind, why? Because when looking at the yield, or looking at it from a yield perspective, the drop yesterday in gold does not make any sense, or it makes sense when when considering gold, not as bullish as I do, but more seeing gold weaker, especially if those trade negotiations between the US and China falling apart due to the current strong positive correlation of the Chinese yuan renminbi and gold. So usually if one rises, the other should rise too. The Chinese yuan renminbi yesterday after the news of the meeting of Trump and Xi hit the wire, the yuan was under pressure and also put gold under pressure then. So this is definitely something worth considering here in this context. But yeah, first things first. So euro against the US dollar, given this picture in US yields, this is definitely something worth considering and be careful about when going for short engagements in the euro. Probably the US dollar shouldn't be the first choice here in this context. But, and now it becomes interesting, but it becomes an option when looking at the euro against the Australian dollar. So what we can clearly spot is that the euro against the Australian dollar is trading within a range, and all in all, it seems to trade within a neutral environment from a pure technical perspective. So when on top of that, looking at the fundamental perspective, we are not only having an ECB, which is dovish and which is bearish euro, but we also had an RBA already last week on Tuesday, which was also somehow quite dovish here, and especially when looking at the
developments in the Euro Australian dollar past the RBA decision and after the comments from the governor, RBA Governor Love, market participants really started to speculate whether the next move of the RBA is a move down in terms of rates here, so then we also had some weak fundamental data. The GDP, for example, last Wednesday did not convince. Australian GDP data did not convince. So when looking at it from this perspective, technically and also fundamentally, you don't have an advantage with one currency over seeing an advantage one currency over the other. So, but from a seasonal perspective, especially given the overall weak standing, let's say, of the Euro Australian dollar becomes highly interest or of high interest given seasonality, and that's something I've already prepared. Let me just bring it over here. So this is the pattern we are looking at, and this is, by the way, here. So this turquoise rectangle is the period. It's March 18th till April 10th. Okay, so and in 79% of the cases over the last 24 years, in this case, then 19 out of 24, Euro Australian dollar lost, so respectively went down, and saw an average gain of 358 pips lower, while the 5 times it did not work out, this pattern, it lost on average 166 pips with a max loss of 288 pips in this case. So this is starting from next Monday onwards. So with the closing price next Monday for the upcoming 3.5 weeks till the 10th of April, we expect from a seasonal perspective, Euro Australian dollar to go down here. And this happened over the last 24 years, again, in 79% of the cases. The question now arises, okay, how can we trade this, especially in terms of a max loss here of 288 pips? Is there any way to trade this pattern then? And the idea is really by the open or effectively the close of the Monday candle. So currently this is 10 p.m. GMT then, and we are selling this Euro Australian dollar, this currency pair then, and the stop is placed 288 pips away, so max loss here. So the average loss is below that, so we could also say we work with a tighter stop, but this stop we can consider worst case stop here. And the reason we take this stop and not the current volatility is also because working with the stop, which is in this case here based on the ATR 14 and only around 100 pips away, seems given the stats of the past, seems just too tight. And so the trade then stays just open till the closing price of the 10th of, there we have it, till the 10th of April, and there we just take it out at the closing price. So that's it. So we just stay in the trade till the 10th of April, have our stop at 288 pips away from the entry price, and then we take out the trade wherever it may trade. And if the stop wasn't hit during this time span, we just take it out at the closing price of April 10th. So I think this is a very, very interesting pattern, especially given the current fundamental situation in the euro and my overall skepticism in the euro. The only thing which is currently, in fact, playing against this pattern, in my opinion, respectively playing against the expected weakness in the euro, and which could result in the seasonality not playing out this time, in my opinion, is the current correlation, positive correlation between the euro and pound sterling and the developments we have seen here over the last days then. So today you can find, by the way, in the traders block on the website from Admiral Markets, let me just take out here this one, and we'll come to this tweet from Donald Tusk in a few seconds. But in the traders block, you can find the current market analysis. Uncertainty around Brexit remains, but GBP/USD nevertheless bullish. So you can obviously spot in the headline that pound sterling is expected to perform well against the US dollar. This can be found here on admiralmarkets.com, and then you go to analytics and here traders block, and then it's the first article right at the top. So what just happened? It can all be also read here within this article. When looking at the developments of the last week, I have to say nothing new was presented. So everything what happened over the last days till Tuesday, the vote on the deal which was negotiated by Theresa May, till Thursday, yesterday, when we talked about an extension of the Brexit deadline, where the UK Parliament had also to vote about, and already on Wednesday, then the question. Is anyone in the UK Parliament, or do we want a no deal Brexit? And nothing. What happened, in my opinion, is of not excitement. That's the wrong word. Is surprising at all. So first of all, it was not very likely that the deal from Theresa May would get a yes then on Tuesday. Sure, at Monday there was already news that there was another solution found around the backstop between the Irish border. But the thing about this is that already in the afternoon of Tuesday, while in the evening we had this vote, so here in Europe, respectively in London, the thing is that attorney, was he an attorney? So the expert on law, his name is Cox. That's what I definitely know, and he's giving the yes or the no, and so he already said that the deal, which was then renegotiated in regards to the backstop, did not deliver anything new. So he already said this is nothing new, which is, by the way, somehow difficult in my opinion, because just imagine someone is coming to you and saying, hey, I renegotiated the backstop, and then you give this to a lawyer, he looks at it and he says nothing happened here, nothing changed, it's just another wording or whatever, but nothing really happened from a law perspective here, which is already very, very difficult in my opinion. But that was already clear that Theresa May would get a no here. The only question was how wide would the margin be between yes and no's, and it was again crushing. It was a crushing defeat. We had 242 who said yes, while 391 said no, which is can be considered crushing, to be honest. On Wednesday, then, the Parliament nevertheless said, even though it was way closer, but they rejected a no-deal Brexit. Also something which we heard several times over the past here. And then yesterday, they voted for an extension of the Brexit deadline past March 29th. 29th. The interesting thing about this is now, in my opinion, that from a legal perspective, nothing changed here too, because this amendment is not legally binding and it does not change the Brexit deadline, even though then here the tweet comes into play from Donald Tusk, even though it is very likely that that here the EU is of it is of interest for the EU also to extend the deadline. And this is already something which you can find here in this tweet. So during my consultations ahead of UCO, so European Commission in this case, I will appeal to the EU27 to be open to a long extension if the UK finds it necessary to rethink its Brexit strategy and build consensus around it. So this is also something now where you might wonder, okay, that does not, it sounds, yes, there will be an extension, but nevertheless, does it really mean that there will significant change to the Brexit strategy? So far, it doesn't look as if, even if they extend the deadline, that they will find a deal very soon. This is true. Nevertheless, it results in stability, at least short-term stability, which will probably then favor pound sterling gains. And this is also, in my opinion, the main reason why we've seen such an aggressive push higher here on Tuesday already. On Wednesday already, once this no deal was rejected from the UK Parliament, and the attack here at 33.50, 34 around. I think the main reason, the main driver here for this push higher is, or can clearly be found in the fact that market participants are now expecting a very favorable solution in terms of the Brexit for the UK and between the EU and the UK. If a Brexit happens at all. So several times over the last days, Theresa May mentioned the second referendum more often than her direct how to say that? It's not an enemy. It's the other side from a political perspective. So the Labour leader Corbyn, he said that he also is open for a second referendum, but it wasn't mentioned that often as it was mentioned by Theresa May herself, which means nothing more to me, in my opinion, that chances are increasing right now, or at least market participants are probably speculating that there will be a very soft Brexit, if there will a Brexit at all, extending the deadline over and over and over again probably, and no Brexit will happen. Everything stays the same, which will then most likely also leave the Bank of England in a state where they say, okay, sure, we have to wait and see how to move with our monetary policy. But in such an environment we're currently in, we don't need to fear that there will be a hard Brexit, a no-deal Brexit, which means, well, we can at least stay neutral on the on our outlook in terms of yields. And there now the employment situation on Tuesday, respectively, the inflation rate on Wednesday comes into play. If those two data sets surprise on the upside, in addition to a neutral standing from the Bank of England next Thursday, this could drive pound sterling higher, especially given the expected weakness in the US dollar, which I just drawn based on the yield. So, which means nothing more than if we expect the US dollar to stay weak, while here the outlook for pound sterling seems to be positive, this could then result in a push above 33.50, 34, a break above that level, and then level the path up to 36 to 36.50. And so with this in mind, the outlook for pound sterling is bullish. We also know about the positive correlation between the euro and pound, and this is something which could then act as a counterweight, let's say, when looking at the expected weakness in the euro from a fundamental perspective, but in terms from euro Australian dollar, also in terms of a seasonal perspective. Yeah, and so that's it on the currency front. And finally, let's have a look here at gold. Let's see whether we'll get to see a weekly close above 1,300 USD. Once again, I want to point out that that when looking at yields currently, we have to say that this drop yesterday really shows weakness in gold. is most likely driven by the uncertainty around the deal between the U.S. and China in terms of trade, and given the fact that we also know there's a currently positive correlation between gold price and the yuan renminbi, which means one rises, then the other should follow, and the other way around. If these tensions reduce over the next days, I could imagine, and also from a chart technical perspective here on a 4-hour chart, as long as we trade above 1,291, another stint up to these highs around 1,311 becomes likely. So the short-term outlook for gold, given also the weakness in US dollar, in my opinion, is currently bullish, and I really expect a stabilization, significant, sustainable stabilization above 1,300 USD, while on the other hand we have also to see that a drop below 1,291 is bearish, short-term bearish, but it's not significant, at least not as long as we do not then go for a break to or below 1,275 to 1,277. So currently the outlook is neutral with a bullish touch. If we drop below 1,291, we go to neutral with a bearish touch and a first target at 275, 277. And if we go below 275, 277, further losses are likely. Then I consider the overall picture in gold bearish and the target around 1,240 USD to be activated. Yeah, and that's it from my end. So I hope you enjoyed the webinar. Also, feel free to check the traders blog on the website from Atma Markets, as I've shown you. The recording will be available in a few minutes. And so that's it from my end. I wish you happy trading. Watch your stops. Have a great next week of trading. Be aware of the Fed rate decision on Wednesday. And yeah, talk to you again next week then on Friday, 22nd then of March. I look forward to it. Take care. See you and bye-bye.